Can the average investor beat the market, or is the stock market really just a random walk? Welcome to Grow Reads, where we distill the world's most important books into deep. The answer is clear: you can't beat the market consistently, at least not through timing or stock picking. The market is largely efficient, and prices already reflect all known information. Instead of gambling, Malkiel recommends a long-term, disciplined approach rooted in diversification, cost minimization, and index investing. Key takeaways. 1. What is a random walk? A random walk refers to a path where each step is random and unpredictable. In stock market terms, Malkiel argues that short-term price movements are essentially random and not predictable. Past movement or direction of the price of a stock or overall market cannot be used to predict its future movement. He challenges technical analysis, chart reading, and fundamental analysis, earnings-based predictions, claiming both are unreliable in the long run. 2. Early history of investing, bubbles and manias. Malkiel begins with a fascinating history of financial bubbles. Tulip mania 1637, prices of tulip bulbs skyrocketed irrationally. South Sea bubble 1720, overspeculation caused a market collapse. Dot-com bubble 1999 to 2000, tech stocks soared based on hype, not fundamentals. Lesson: human psychology drives booms and busts. Emotional investing leads to irrational behavior, even in sophisticated markets. 3. Technical versus fundamental analysis. Malkiel critiques both main approaches to active investing. Technical analysis, using past price charts to predict future movements. He argues this fails because of the efficient market hypothesis, EMH, all information is already priced in. Fundamental analysis, valuing companies based on earnings. Growth and management, though more grounded. It's still subject to overconfidence, bias, and unpredictability. Conclusion: stock picking is difficult, and neither method consistently outperforms the market. 4. Efficient market hypothesis, EMH. EMH is the cornerstone of Malkiel's philosophy. Weak form: past prices can't predict future prices. Semi-strong form: all public info is already reflected in stock prices. Strong form: even insider information is already priced in. Implication: no one, not even pros, can consistently beat the market without taking on excessive risk. 5. The firm foundation and the castle in the air. 2. Investing theories. Firm foundation theory: stocks have an intrinsic value based on fundamentals. If market prices deviate, they will eventually revert. Castle in the air theory: stocks are priced based on popular psychology, what the crowd thinks they're worth. Malkiel acknowledges both forces at play, but warns against betting on crowd behavior. 6. Behavioral finance: why we're irrational. Malkiel anticipates the rise of behavioral economics. Investors often overreact to news, exhibit herd behavior, suffer from overconfidence, anchor to irrelevant data, fall victim to FOMO and panic selling. Lesson: emotions sabotage returns. Rational long-term investing outperforms impulsive behavior. 7. How the pros perform. Malkiel presents evidence that mutual fund managers and hedge funds underperform index funds over time. Fees, taxes, and trading costs erode returns. Key stats: 80 to 90% of active funds fail to beat the S&P 500 over 10+ years. Very few top-performing funds remain consistent. It's not that professional investors are stupid. It's that the market is just too efficient. 8. Indexing, the best bet for most investors. Rather than picking winners, buy the whole market. Index funds offer low cost, broad diversification, consistent returns. Recommended portfolios: Total Stock Market Index, International Stock Index, Bond Index, REITs Real Estate. 9. Life cycle investing, a strategy for every age. Your investment strategy should evolve with your life stage. 20s, 30s, mostly stocks, higher risk, higher reward. 40s, 50s, add bonds for stability. 60s plus, prioritize income and capital preservation. Malkiel supports target date retirement funds that adjust allocations automatically. Rule of thumb: subtract your age from 100 to get the stock percentage in your portfolio. 10. The role of bonds and real assets. Bonds provide safety and income, include a mix of treasury bond, municipal bonds, corporate bonds, real estate via REITs adds inflation protection. Gold commodities have a minor role, more speculative. $11 cost averaging. Instead of trying to time the market, invest consistently over time. Example, invest $500 monthly into an index fund, regardless of market conditions. This reduces the risk of buying at peaks. 12 taxes and fees, silent killers. High fees and poor tax strategy destroy wealth, Malkiel urges. Buy and hold over frequent trading. Use tax-advantaged accounts, IRA, Roth, 401k. Choose low-cost ETFs and index funds. 13. How to read the market without being misled. Ignore daily news, most headlines are noise. Focus on long-term trends, economic fundamentals, diversification and allocation. Market predictions are unreliable even from experts. 14. The role of risk and return. Risk and reward go hand in hand. Trying to get high returns without high risk is a fantasy. Malkiel uses the capital asset pricing model, CAPM, to show higher risk beta equals sign higher expected return. Diversification reduces unsystematic risk. But remember, even safe assets can lose value. 15. The rise of new investment products. Since the first edition, the market has evolved. Malkiel offers his view on ETFs, great tools if low cost and broad-based. Crypto, highly speculative, don't bet your future on it. Robo-advisors, efficient and useful for beginners. Thematic funds, often overhyped, watch fees. 16. 10 rules for financial success, Malkiel's final advice. 1. Start early, compound interest is magic. 2. Live below your means, save more than you spend. 3. Invest regularly, automate it. 4. Diversify, don't bet on one stock. 5. Rebalance, maintain your intended allocation. 6. Avoid timing, stay the course. 7. Minimize taxes, use retirement accounts. 8. Control emotions, avoid panic selling. 9. Avoid fees, they eat returns. 10. Stick to the plan, patience wins. 17. Malkiel's personal portfolio philosophy. Even as a Princeton economist, Malkiel invests the same way he advises readers. Broad index funds, dollar cost averaging, rebalancing, long-term mindset. It's not timing the market, it's time in the market. 18. For young investors. If you're under 30, here's what Malkiel recommends. Aggressively invest in stocks. Prioritize Roth IRA or 401k. Choose target date or total market index funds. Stay invested through ups and downs. This is your most powerful wealth-building decade. 19. The future of the market. While markets will evolve with AI, digital currencies and globalization, the principles remain. Markets are largely efficient. Low-cost, diversified investing is unbeatable. Long-term thinking trumps all. 20. Final thoughts, the wisdom of simplicity. Malkiel's entire message can be summed up as: don't try to outsmart the market. Focus on what you can control, costs, behavior, asset allocation. Let time and compound growth do the work. Grow reads takeaway. Success in investing isn't about genius, it's about discipline. Patience and humility. A Random Walk Down Wall Street is one of the greatest financial guides because it rejects flashy shortcuts and delivers lasting principles. If you found this summary valuable, subscribe to Grow Reads for more deep dives into world-changing books.